Donald Trump's unexpected decision to put on hold many of the steep import duties imposed on various countries earlier in April has come as a relief to investors and political leaders alike. Wall Street cheered the move, with US indices posting their biggest single-day gain since 2008 on Wednesday. Asian markets followed suit on Thursday, bouncing back after days of turmoil. Indian markets missed the global rally because they were shut on Thursday for Mahavir Jayanti. But when trading resumes on Friday, a similar relief rally could play out here too. The bigger question here is, will this rally continue, or is it merely a temporary rebound? After all, the economic conflict between the world's largest economies, the US and China, has only intensified with Trump keeping the pressure on Beijing by further increasing tariffs on Chinese imports. Moreover, the US has its own set of economic problems and the outlook remains complex. It's Friday, April 11th. I'm Nishanth Vasudevan, Markets Editor at the Economic Times and your host for today. You are listening to the Morning Brief. Joining me today to discuss this ever-shifting economic environment and its implications for investors is Sankaran Naren, one of the most seasoned minds in the market today. Naren is the CIO of ICICI Prudential Mutual Fund and brings with him over 3 decades of experience in the market. Let's hear from him on what all these events mean for the market and what's in store for investors. Welcome to the Morning Brief, Naren.
Very nice talking today to you.
Naren, a lot has changed in the past 24 hours. We have had Donald Trump do a U-turn. He seems to have put a lot of plans on hold. The first question, obviously, it has to be whether the worst is over for the markets, given that Donald Trump has actually put a 90-day pause on the tariffs. Does that really change a lot of the bear case estimates?
So I think in the very near term, I think the market has possibly settled. But we have to understand that where is the problem? The problem is that US had a very high fiscal deficit and had a very high current account deficit. Both these are problems which are not going to go away by the U-turn in Donald Trump's policies yesterday. And while the market could have seen a short covering rally yesterday, these are fundamental challenges which are there in the US economy. And you have to remember that actually 10% universal tariff stays on all imports into US. So yes, are we going to see a continuous fall in the markets like what we saw over the last 10 days? May not be, but we have seen a rip-roaring relief rally yesterday, which must have taken all the short sellers out. So that's the situation.
But actually, I mean, especially the point that you mentioned that he's only kind of deferred it. The big concern actually remains the continued, the intensified tariff war with China. I mean, neither sides seem to be in a mood to let go. Given this scenario, is a big downturn in the US or even a recession, is that a possibility?
Clearly, I think US economy has been the engine from 2011-12 till today. I think that engine is going to slow down significantly and we have to prepare ourselves for it. And there is clearly there is a China-US trade war, which doesn't show any sign of ending because both have taken extreme positions. Is it bad for India? We can discuss, but definitely it is a problem that the top 2 economies in the world today are having a trade war with each other.
Now, what does this basically mean for the Indian economy, the Indian markets as such? What should investors make of this?
See, I think clearly if you look at it on a relative basis, I think India is in a better position than USA. India is in a better position than China. Whether it is fiscal deficit and current account deficit, it is much better than USA. If you look at the geopolitical situation that China is in, India is in a very, very good position compared to China. The only challenge has been that markets have been overvalued. That is also corrected to some extent. So we have only a minor overvaluation in large caps at this point of time. So overall, the environment that exists in the world is much more positive for India than it has ever been, given that the top two economies on the world have their own challenges, whereas we don't have any challenges except some amount of overvaluation in large caps and some larger overvaluation in small and mid cap.
Naren, this entire decoupling theory that India will not be impacted by what is happening around. We had this kind of theory surfacing every time it has happened in the 2000s. Now again, this kind of a theory is surfaced. You think that is possible?
I think there's no concept of decoupling. There can be a concept of outperformance. Have you seen Indian market do well when US did badly in 2001? To answer no. Did India do well when the market did badly in US in 2008? The answer no. When COVID happened, did India do well in an absolute basis? No. So I believe that India can outperform the world. That is possible. Particularly, can it outperform US? It's quite possible. And India can use this opportunity well. Because if you look at companies like Apple and various other companies, I think they need to change their entire model of being over dependent on China and move to another country. And India is possibly the only country which they can use as a sourcing base for their products. How it can make use of them is going to be very, very interesting. Will it happen? Will it not happen? We don't know. But an opportunity has presented itself to India.
Again, from what you've seen in the past few days, how are the corporates reacting now? Will this 90-day pause, does it change anything for them, or does uncertainty keep lingering for them?
For corporates, it's a very, very difficult situation. Do you know it's going to go away in 90 days or you're going to have some tariffs? First of all, if you take a sector like textiles, for a few days, the Indian textile industry was rejoicing that the other countries were having even higher tariffs. And those countries had no choice because they have only textiles in their basket to export. And they were rejoicing that India's tariffs were much lower than what was there on them. So does the textile industry rejoice now or cry now? So I think it's a very, very difficult environment. And even as investors, we are struggling to think how to look at all the companies which have to export to US in goods and what will happen to them, what kind of results are they going to show in the next few quarters. And we are struggling how to think of that.
And so, what does this now mean for investors? Because the same concerns that corporates are facing, now investors also face the same kind of concerns. You don't know whether, what you should be doing at the moment. You don't know whether what is going to happen to the markets maybe 3 months down the line or 6 months down the line. What are your thoughts? How would you assess the situation?
See, that is very simple actually. I think over the last 18 to 24 months, what have we been telling people? 18 months, we have been telling people practice asset allocation, which means don't put all your money only in equity. Maybe you have to be a bit more cautious on gold because gold has done too well at this point of time. But otherwise, I would say the thing that we have been trying to tell people is focus on all the asset classes. Do not put all your money on only equity. And we have been telling people focus on quality, focus on contrarian investing. Think of interesting themes which have not done well, like rural. And that is the kind of framework that we have been actually telling. And we have been liking large caps over small cap and mid cap. This is what we've been telling. Nothing changes there because India is a domestic economy. India is not an economy which is dependent on trade. So nothing much changes. If the market were to correct a little bit more, it would make sense to be much more positive on equities. There is nothing wrong with Indian macro at this point of time. So nothing must just change from an investor construct point of view. What has changed is 1 year back, I think Indian investors were just too positive and that led them to some losses. Now I think investors are likely to be more balanced. So I think that will help them in times to come.
Naren, if you could just put that in numbers, you said that there's a little bit of overvaluation in large caps, while of course mid and small caps, obviously they remain overvalued at the moment. But if you were to put that in numbers, at what level would you consider large caps undervalued or maybe really cheap?
I think sub 21,000 Nifty, I would say large caps would become undervalued
Yeah.
and markets can become undervalued, markets can become overvalued. Whereas I would say both mid caps and small caps have some way to go. Is it 10% or more? That's very difficult to say because suppose you have a good monsoon, you have oil staying down, that is very positive for the economy. Interest rates are coming down. And, the central bank has been very, very dovish and helping the economy by cutting rates and injecting liquidity. All these are also positive. So even the downsides in small cap and mid cap are coming down with this kind of a supportive central bank and crude coming down on a continuing basis. So overall, I would say compared to, let's say, 9 months back, I would say that the equity market is less risky than it was at that point of time. Although the global environment looks much worse, I would say for an incremental investor, the valuation and the whole environment looks actually safer than what it was last year in September.
Just to kind of take the discussion a little forward, one thing, there's been a lot of debate about value versus growth. So in the past 5 years since COVID, value stocks like PSUs, defense, infrastructure, they have beaten growth like consumers, private banks. A lot of them have doubled, gone up 500%, 5 times, 10 times. Do you think that cycle is over? Do you think growth might return? Because many of these stocks are still trading below their pre-COVID level.
We actually thought that sectors like defense and railways and all that, some of the EMS sectors, electronic manufacturing sectors, some of those sectors were looking extremely overvalued to us. And we thought that they are far away from value now. Maybe they were value in 2020. They were opposite of value at this point of time. In fact, in our framework at this point of time, we are much more liking quality sectors because they are the sectors which have done very badly from 2020 to now. So, from a contrarian viewpoint, we are much more positive on quality at this point of time than the deep value kind of stocks which we used to like in 2020. In fact, many of those deep value sectors, even small cap and micro cap, they've all done too well at this point of time. That today we are much more interested in quality sectors, which actually have been the dogs from 2020 October till now.
And within quality, I mean, is there any specific theme or any sector that you feel that there is still a lot of value? I mean, if we were to combine both value and growth, do you see any such theme where you are still finding some amount of deep value?
See, I think, we have to be very careful when you're investing in new age companies which are declaring EBITDA loss, cash losses, where there is only top line. There has been a lot of individuals who've started to invest in unlisted stocks. Many of the SME IPOs which have taken place. And, the regulator also made a lot of effort to bring out the risks in the derivatives market. So I think these are some of the areas where we've been actually cautioning people. I think the quality mega caps, many of the quality companies, and but we're not able to spot specific sectors which look very, very cheap at this point of time because the market itself is not yet very, very cheap. In the olden days, we used to have these metal sector and telecom sector and all these sectors which used to be very, very cheap.
Right.
We don't have such sectors at this point.
I mean, of course, multi-asset allocation is the best way to go about it. But if you look at gold, which has been one of the best performers in the past maybe 2 or 3 years, do you think there is scope for being overweight on gold? Do you see gold outperforming the way it has outperformed in the past maybe 1 or 2 years?
See, actually, as part of a framework, what we do is we look at the sector which is done best on 1 year, 3 year, 5 year, 10 year, 15 year. And today that is gold. And normally what we do is we don't normally give a big buy call on that sector. So, we are much more careful in gold because it has become the best performing asset class at this point of time. So,
Right.
gold and silver within a multi-asset framework is a small investment, but no longer does it appear to be something which is contrarian. It is just the opposite of contrarian at this point of time. So, it's very difficult. Why is it happening? It is because people have lost faith in the US dollar. Some of the central banks get worried. So if you look at the last 3 days or the entire in this tariff exercise, normally the US dollar appreciates and the US Treasury yields go down when equity markets go down. Instead, you had a situation where the US yields went up, and that is a very, very surprising development, which means that people no longer use the US Treasury as a risk-free asset, which is a very worrying development if you're thinking of the US government, because in earlier periods, whenever the US market came down or whenever the global markets came down, the safe haven used to be the US Treasury and US dollar. And this time it was gold. And this is very worrying. So I do agree that gold is going to go up. If the global turmoil were to expand, gold would be the instrument which could do well.
Right. Naren, just a last point, you spoke of something which is of great importance at the moment, which is the rise in US bond yields. I mean, especially when there is so much of turmoil, so much of chaos around. What do you think explains this kind of behavior especially in the US Treasury market?
Actually, US Treasuries is considered to be the world's risk-free asset.
Yeah.
So, when the US Treasury yield started to go up, it rang alarm bells in the entire world.
Yeah.
And there is a lot of refinancing of the debt which is due in the next 1 year by governments, corporates across the world. And it's a very worrying development if the global risk-free asset yield started to go up. And we are hoping that this market actually settles down. Because, it doesn't help the world if US yields go up. Because even if other countries, it's as though the global central banks are actually tightening. It's that kind of an impact. So we at ICICI Prudential watch the US 10-year yield as one of our very important research input into what we do when we are managing public money. And the developments in the recent past where US yields went up sharply is a worrying development. We would want it to correct, particularly when equity markets correct.
That's it for today. The key takeaway is that while Donald Trump's decision to back off on most of his tariffs is a big source of relief for investors, it's too early to conclude whether the worst is behind us. Moreover, India's share valuations are still not cheap, so it may not be the best time to go all in on equities yet. Thank you once again, Naren, for joining us and sharing your valuable insights, and a big thank you to all our listeners. This episode was produced by Vinay Joshi and Anirban Chaudhary, and the sound designed by Rajas Nayak. The Morning Brief drops every Tuesday, Thursday, and Friday on your preferred audio platform. So be sure to tune in. This is your host, Nishanth Vasudevan, signing off. Have a great weekend.